Well, hello, folks. I'm L.A. Little, and this is your daily NeoTA wrap. We take a look at these markets, and we do it from a neoclassical perspective. Each time we ask ourselves what happened today, and what does it tell us about the coming ones? I do this show 4 times a week. I do it every Monday through Thursday. It's broadcast at or before 10 o'clock Eastern Time. Archived on YouTube. It's under the channel L.A. Little. You can get it there anytime, any place, on any device you want. Talk about any device. Talk about any time. Talk about markets. What a day. Finally, we're getting something that's interesting here. We're going to go to that in a second. First, let's look at the numbers. We still had composite NDX up on the day. We had a little bit of a pullback elsewhere, but I mean, these were basically just flat. Gold, down again. Copper, where's copper? Copper was up slightly. Silver down. Bonds down. Everything down, dollar up. Very mixed. That's on the surface. Let's go underneath, though. Because, we've had quite a run, and that's an understatement. And, now we're up here at the highs. And we're going to start with the S&P, but you're going to see basically the same thing on all of them. It's just the S&P has everything. And what I mean by that is the S&Ps was one of the only two, right? Of the 5 indexes, the S&P and the Russell were the only two that had not made new highs yet. S&P was sitting at a new high on Friday. They got up to 2018-19. That high over here, 2019-26. So just barely not over it, right? Well, today they go over it. And we suspected they would go over it. And what do? They go over it with less volume. They test over that high. Again, that high is 2019-26. They close at 2017-81. It is a doji, which can be a turn. It's over the high, fails. What is that? That's a test failure at the highs. It's after an extended move, and it's a 2-bar reversal. You had a high of 2018-19 on Friday. You close underneath that, so you go over it, back under it, less volume. That's pretty much the whole ball of wax. And if I had to make a big bet, this would be where I'd make it, because you've got everything that you want right here in this trade at this particular point. This should pull back. If it doesn't, it's a beast that I can't even begin to describe, because everything is in place. The extension is there. Remember, we had a 2-bar extension before that we thought was going to give us a pullback. That was this one, although the spread between the volumes wasn't that great. And at that point, even though it was a big move, it wasn't nearly as extended as it is now. Now you get the same sort of setup. Volume characteristics quite a bit different. Extension even greater. And you have test failure at the highs. That's about all you can ask for. So question is will it pull back? We know it should pull back. If it does, how does it pull back? In other words, where does it come back to? How deep does it get? That will be the question, not just here, but probably elsewhere is where we'll want to really measure it. Let's pop over, look at the Dow. Dow has kind of the same setup. Now, it was already over that high. Suspect breakout, but it goes over, back under, a lot less volume, 2-bar reversal. Same situation on the Dow. NASDAQ. Now here's where most people would see it probably different, but for me, this is a 2-bar reversal as well. 46, 41, 51. You go over it. You actually close higher, but you close underneath that high. So 41 was the high, you close at 38. So even though you close higher than Friday's close, You close lower than Friday's high, less volume, extension, that's a 2-bar reversal. You got the same setup on the NDX, over, back under. You close just slightly under the high, 41.70.87, just barely, $1.50 or so. And finally, if we go over the Russell now was testing this swing point high, had gotten over it, was into the last bar up, goes over it, back under it, less volume, 2-bar reversal. 5 indexes, all 5 incongruents, saying the same thing. If it doesn't pull back here, honestly, I don't know what it's telling us, because, you know, everything's in place. Now, if we look at the sectors, you know, it's not nearly as clear. As a matter of fact, it's not supporting this at all. But when you get 5 indexes after an extended move like this, saying the same thing, I don't think the sectors are going to change things. I'm not going to go through them all, but just to highlight a few, some of the stronger ones, SOX made new highs. The IBB was pulling back, but nothing severe. You did get a 2-bar reversal on the IYT, so that's actually incongruence. XLE, another sell off in the USO today in the oil markets. XLE ends up closing down, I think about 1%. What was it? 1.5%. XLF makes new highs and holds them. So you can see that there's a difference here. You got new highs, XLK. And probably the most interesting part of this whole move is the sector still leading are the safety guys, XLP and XLU. That's kind of curious, and it continues. And remember, we did a spotlight on that last week about how that probably shouldn't happen, but it is happening. You know, for the most part, sectors don't look too bad. What does that tell me? Even though we should get a pullback, and actually let's rephrase it. When you get 2-bar reversals, that says the next bar should be sideways to down. You know, if it's an over-under. If it's the reverse, in other words, you're under-over on a 2-bar, then the next bar should be sideways to up. In this case, should be sideways to down. Given the sector strength, we may see just a slight pullback as a result. In other words, nothing heavy tomorrow. And that's when we'll have to look at the sectors tomorrow to try to give us more of a clue as to whether that is really going to be a retrace that lasts for more than 1 day sideways to slightly down or something else. And so, you know, given these two things, clear signals that we're going to try to go sideways to down on the indexes, still strength enough in the sectors to hold the markets up, which makes me think that tomorrow, even though we should get the pullback, it's not going to be a big one. So that's that part of the equation. World markets, really nothing different there. I mean, yeah, we had some pullbacks today in Europe. Nikkei was closed. The rest of Asia traded mixed. You've got Australia tonight with the rate decision. There are folks forecasting that they're going to actually bring their rates down given the situation in China. That may be the case. You know, everybody else wants to bring them down, so why not Australia, I guess. So that's what's happening there. Now, over in the OX markets, we've actually got some interesting play here, and that is that, well, one thing, of course, is the dollar. The dollar continues to be strong. Now, if you remember, and actually we can look back here, on the dollar when it made this big run off of 21.70 all the way to 23.10, so a $1.40 move, which was, you know, in a dollar, that's a pretty fairly significant move. When it made that move, remember, about halfway to 3/4 of the way through this move is when the equity markets around the world started to take notice and begin to sell down. So it was like the middle of September, if you remember, in our markets where we topped. The rest of the world was starting to top already and was starting to move down at that point. And they were really moving down by the time we got going. Fast forward to today, UUP breaks out again, right? Broke out yesterday, or actually Friday, on the Japanese news of, more easing. Today extends that. A little bit more volume comes in, extends, holds over the high. Again, it's got an ABCD structure here, though, that it just completed. So it looks to me like we're probably going to get some sort of a retest regen before it extends any farther back into this high. The point of bringing up this, though, is that we've got ECB Thursday, along with the Bank of England, Australia we talked about tonight. I'm sure there's expectations to some degree that the ECB may do something, or at least Draghi's going to say something. Because if you look over at the FXE, the FXE is down here at the lows trying to break down. Now we know the yen broke down tremendously and extended today off the news of more quantitative easing in Japan. Well, clearly this chart is telling us that the expectation is that the FXE is going to share the same fate and do the same thing. If so, dollar is going to push up. It's going to put more pressure on commodities. Eventually, that's going to be an issue probably for equity markets, just as it was before. The other piece of that equation, though, and I'm going to go back to the dollar one more time. The dollar peaked October 3rd on that first leg up. About halfway through was about the first week of September. Let's flip over to the bonds. The bonds made a low, what? About halfway through that dollar move, and then they started to reverse as what? As the markets started to sell off. Fast forward to today, dollar starting to break out, bonds starting to sell off again. How long will that go on? Well, the correct answer probably is until the equity markets start to sell off. So, even though the dollar, if the dollar continues to spike, then I would expect the bonds to continue to come down until the equity markets start to get hit. Now, if the dollar does hold and pull back in like we were just wondering, and start pulling back in here, well, then it may be a different story. So I believe it's important to keep watching how this dollar acts, what happens with the FXE, with Draghi come Thursday. Believe me, if they do some more juice, the dollar is going to shoot straight up, and probably the equity markets, depending on what's said, the equity markets are probably going to try to pop on it. But folks, we didn't get a sell the news last week. We may get a sell the news this week if we're still hanging up here at the highs, and especially if Draghi and the ECB don't pour any gasoline on the fire in terms of quantitative type easing or easing of any sort. And I don't know how they can do it at this point because their rates are almost zero. They got negative rates in some cases, and they can't do QE because it's not in their charter yet. Yeah, they're doing these targeted LTROs still, but it's not quite the same thing. So we'll see. We'll see what he says. Can he juice it? Because, if anything, Draghi has proven he can juice the equity markets without really doing anything about it. Okay, so synopsis-wise, what do we got? Looks to me like we're going to get some sort of sideways to down action tomorrow. Given the sector strength, I'm not sure that we're going to get a big move to the downside, at least not tomorrow. I'm going to spotlight tonight. There was actually a question, and I was looking for a spotlight to talk about tonight. And there was a question about gaps, and so I thought maybe we just spotlight this and talk about gaps. You know, prior to what I developed on my own, with this whole ideal of neoclassical resistance zones, anchored resistance zones and support zones, swing points, automated 3 time frames, same amount of bars, all of that neoclassical thought. Before I went off on all that, of course, I practiced classical TA just like probably all of you, for the first 20 years or so. And one of the main things in classical TA, and I've got the S&P 500, I've got the index up. It's actually easier to see on the SPY. It's not, I don't always like to use the SPY, but I'll use the SPY for the gap case. And one of the big things in classical TA, and I even covered it in my second book, I believe, is this ideal of gaps. I was thinking that it would play a more important role in my neoclassical thought at the time, but it really is something I kind of got away from and started to more or less forget because I didn't find all that much value in it. In the classical world, there's usually 3 gaps, and in the first gap they call the breakaway gap, and this one, if you count this little gap down here at the bottom, and it was a gap, even though here it doesn't quite show it. What is that? 187.58, and the low was 187.62. So yeah, it does. It's like 4 points, right? So there's a gap there. So the first gap, is what is termed as the breakout gap, right? The first one. And some people call it the breakaway gap. That gap is what starts it all, right? And they say they come in 3s, and sometimes they come in 3s, sometimes in 4s, and this one we're going to talk about the 4th one. But that breakaway gap is the one that gets you the next push, and then eventually you get some other gap that comes along, and that next one that comes along they call the measuring gap. And the measure really is to take where it gaps to back down to wherever the low was, right? And then to measure that distance. Now, you'll see 2 different ways of measuring. Some will measure to the gap itself, the top, before it gaps. Some will measure to the gap, where it opens. However you want to measure it, it's either from here or from there. I always try to be conservative, so I usually measure from this area, right? Because I want the least number in whatever I'm doing. I want to be conservative with whatever gaps, whatever measurement tools I use. So if I take that 181, roughly 182 as a low, I go to the top of this bar, which is about $8.5. If you take that and you flip that around and add it to this, that would give you what? 198, 199 basically. So if we take that and we add it on and we say from here up, that gives us 199. So that is your measuring gap, right? It's going to tell you how far this thing can go, or should go, right? What the projection is. And so from here, this distance, let me get a different tool here right quick. So this distance here, right, should be roughly equal to that distance. And lo and behold, that's about where it went before it gapped again. The final gap here is usually called the exhaustion gap. So in other words, you break away, you get a measuring gap to tell you how far to expect, you get some sort of an exhaustion, you get a final few bars that meets your target, and then you pull back. Well, we didn't pull back, and this is one of the reasons, I don't do the classical stuff so much anymore. Because, sometimes it works, sometimes it doesn't. Now, everything sometimes works, sometimes doesn't. But had you tried to use this to short this, it wouldn't have done so good. just based on the projections. You'd have got caught in the gap. And anymore, this happens more and more. And the reason for it is all the QE, in my opinion, and in this particular case, it was definitely the QE because this was the Bank of Japan forcing it up on Friday. So that's kind of the gap theory. When you get the fourth gap, some people say it's a double exhaustion, so you get an exhaustion here and now you get another one. I hate to kind of like create the rules as we go, which is kind of what this is doing. I'd be much more interested in what does it do at places that I know that sellers should show up. If this happens, if this measuring gap happens to come into a place where I expect sellers to show up, then that's a different story. But if you've been watching me, in my comments over the last week or so, or actually a week and a half, once we got this washout bottom, which I actually wrote about and talked about, my expectation is we would get a move up in some sort of a situation where we would come in and create some sort of a range. And my first thought was, okay, typically a retest regenerate, in this case a bearish one, would be the ideal place to see it. So I expected initially some sort of a range into this area. And here it looked like it might do it. Then we opened here and we watched it that day, and then it pushed over it. And then it was like, and then it closed over it, of course. And then it was like, okay, that's not going to be the range. Once you do that, then you have to kind of reconsider, well, where's the next place? And that's where you go find your next anchor resistance zones, and they happen to have been in that area. Well, that also, as you can see, paused it, right? That's where sellers should show up. That's where sellers did show up. But again, it wasn't enough to stop it. Once that overcame, and it wasn't just here, it was on other indexes because you're watching them all, that gave us a fairly good indication that the range wasn't going to be here. It was going to be even higher. And not only that, at the same time, we were getting evidence in sectors that it wasn't even going to be a range. It was going to be a breakout. And so I would be much more comfortable, rather than looking at gaps and projections off of gaps, look at areas where sellers and buyers have to do battle, right? Where one side or the other wins and the other side folds, and use that to know what to do next. And so in this case, independent of the gaps, there were places as we went along, and I invite you to go back and look at the tapes over the last week, week and a half, and just kind of, read through, or not read through them, but watch through them. Each day I said, as we were making these moves, there's still nothing to tell us this thing's going to stop. And we had one day, right, where there was a potential reversal, which was here. And when it opened up the next day, that told us this thing was even more powerful than we thought, and that it was going much higher. And it was that very next couple of bars that held here, but elsewhere we broke out, that told us that these things were going back to the top, most likely. Right? They were going to push the range even higher. That's something that's much more valuable to me than looking at these gaps and the projections and so forth. I just honestly, I know all that stuff. I mean, I practiced it for years, but it just doesn't mean all that much to me anymore. But hopefully, that's an explanation of it and why I choose to use something beside that. Okay, well, that's it for tonight. Thanks for joining me. You tell a friend, tell two. I'm LA. This is, and it was, your daily NeoTA wrap. Have a great night. Let's see how much they can pull this thing back tomorrow, and if in fact they can. If so, then the market's finally going to give us a decent signal, not just to the upside, but for the downside, which is something we haven't seen yet. It's been a week and a half, a good week and a half here, right? Last one attempt was here that failed. Have a great one, folks. Take care. See you next time. Good night.